Good morning, July 3rd, 2025. A lot of activity around the globe. Let's break it all down. Global financial markets have experienced a highly dynamic period, with performance diverging across asset classes and regions. This has been driven by shifting central bank policies and ongoing geopolitical developments. In equities, United States stocks, especially large technology companies, have continued to climb, reaching new record highs. This momentum is fueled by sector-specific catalysts, such as enthusiasm for artificial intelligence and positive company news, like strong delivery updates from electric vehicle makers and trade deals benefiting major importers. Despite concerns about trade tariffs and upcoming jobs data, investor sentiment in the U.S. remains bullish, with a strong focus on corporate earnings and growth narratives. European markets have also performed robustly, outpacing U.S. markets so far this year. The main European index has doubled the gains of its closest rivals, with Germany's market standing out. This marks a significant shift after years of outflows from European equities, as investors are now attracted by narrowing valuation gaps and stabilizing corporate earnings. Notably, some European companies are signaling confidence through large share buyback programs, even as their stock prices dip. In Asia, the picture is more mixed. Japan's market dropped due to a sell-off in technology stocks, but later recovered slightly. Hong Kong and Shanghai saw modest gains, while Indian equities declined after a strong rally, as investors grew cautious ahead of the U.S. tariff deadline. Despite strong economic fundamentals in India, such as manufacturing growth and rising tax collections, sentiment indicators suggest the market may be overheated, with foreign investors selling and the local greed and fear index entering extreme territory. Some Indian stocks, however, have been highlighted for their technical breakouts and growth potential. Turning to fixed income, U.S. government bond yields have risen across the curve, reflecting market adjustments ahead of key economic data. This suggests investors are bracing for potentially stronger economic numbers, which could delay or reduce the scale of expected interest rate cuts. In Europe, German bond yields have also increased, but many strategists still see value in investment-grade European bonds, which now offer returns comparable to stock dividends. Japanese bond yields, meanwhile, have stabilized after a recent surge, as the central bank maintains its accommodative stance. Currency markets have been shaped by a continued weakening of the U.S. dollar, which has lost over 10% of its value this year. This has boosted major currencies like the euro and the pound, while the Japanese yen has remained relatively stable due to Japan's dovish monetary policy. The euro's strength is partly driven by hopes for a U.S.-European trade agreement, and the European Central Bank's efforts to position the euro as an alternative reserve currency. The British pound has also advanced, though it may consolidate before moving higher. The Australian dollar's recent gains are mostly a reflection of U.S. dollar weakness, and it may struggle to sustain these levels. Commodity markets have sent mixed signals. Oil prices have held steady, with traders cautious ahead of a key meeting of major oil-producing countries. Earlier, oil surged on Middle East tensions, but prices have since retreated as supply disruptions failed to materialize and economic concerns grew. Gold, traditionally a hedge against geopolitical risk, has rebounded slightly, supported by ongoing central bank buying, especially from countries seeking to diversify away from the U.S. dollar. However, some investors are rotating into silver, and gold's risk premium appears to be fading. Central banks remain at the heart of market dynamics. The U.S. Federal Reserve, European Central Bank, and Bank of England are all signaling possible rate cuts later this year, in response to moderating inflation and slowing growth. In contrast, the Bank of Japan is sticking with its ultra-loose policy, even halving the pace of its balance sheet reduction. This divergence is a key driver of currency movements and is contributing to the U.S. dollar's weakness. A notable development in U.S. liquidity management is the sharp decline in the use of overnight reverse repurchase agreements as money market funds shift towards private repo holdings. This suggests that investors are finding better returns outside of central bank facilities and that the private short-term funding market is becoming more active and healthy. Money market funds have also seen strong asset growth and are reallocating from government securities to private repo and commercial paper, reflecting changing market conditions and issuance patterns. Political and geopolitical factors continue to shape markets. The looming U.S. tariff deadline is a major source of uncertainty, with potential to trigger volatility in equities, bonds, and currencies, especially in trade-sensitive sectors. However, not all news is negative. Targeted trade deals, such as the recent agreement with Vietnam, have provided immediate boosts to certain companies. The U.S. and China have also reached agreements to ease tensions in areas like rare earths and technology access, showing that trade policy can create both risks and opportunities. In Europe, political debates over climate targets are adding to uncertainty, as some leaders warn of economic harm and political backlash. Meanwhile, a major defense alliance has agreed to raise spending, which is likely to benefit defense-related stocks. Broader geopolitical tensions, such as the recent Middle East conflict, have eased, leading to a normalization of risk premiums in commodity markets. Looking ahead, several key events will drive market movements. The U.S. jobs report, the outcome of the U.S. tariff deadline, the meeting of major oil producers, and further central bank communications will all be closely watched. In the near term, U.S. technology stocks are expected to maintain their momentum, though there is potential for profit-taking if economic data disappoints or trade news turns negative. European equities are likely to continue outperforming, while Indian markets may see a correction due to overheated sentiment. U.S. bond yields are expected to remain volatile, and currency markets will be influenced by the ongoing weakness of the U.S. dollar. For investors, the report highlights several actionable opportunities. In India, select stocks in rail systems, insurance, and utilities are recommended for growth and momentum. In Europe, exchange-traded funds tracking the main index are attractive for regional outperformance. Investment-grade European corporate bonds offer diversification and yield, while currency strategies favor being long the euro and short the Australian dollar against the US dollar. In summary, global financial markets are navigating a complex environment marked by diverging central bank policies, shifting liquidity dynamics, and persistent geopolitical risks. U.S. and European equities remain strong, but selective positioning is advised, especially in markets showing signs of excessive optimism. The weakening U.S. dollar presents opportunities in major currency pairs, and close attention to upcoming economic data and policy signals will be crucial for capitalizing on emerging trends. Investors are encouraged to maintain diversified portfolios and actively manage exposure to sectors sensitive to trade and policy developments.